So here's the story that really struck with me. A copper developer, pre-feasibility stage, looking to get a roadshow underway. They had some really strong technicals, good geology, good plan, but they wanted to go out and do something for their capital raise. And they did something very unusual before getting going. They invited two investors to come along, institutional investors to come along with a couple of members of their community, their local stakeholders. And they laid out all of their plans. But particularly important was they also laid out the answers that they did not yet have. The questions to a number of areas like water, labor, local labor, housing, what they were going to do with a number of different areas within their whole risk matrix as they went forward. And they were very clear that they hadn't yet solved these issues. And they invited challenge. They invited challenge very openly between both the investors, but also the community. Now, this could have gone two ways, couldn't it? I mean, let's be honest, but it didn't. One of the investors told the company shortly afterwards that this was the moment when they really began to believe that this management was credible, that acknowledging that they didn't have all the answers immediately at early pre-feasibility sort of stage. And that because that they wanted to work through these questions to effectively come out with solutions that would benefit not only the project, but also the community and everything. And within 6 months, this project or this company had secured its capital, got a founding investors in behind it, and also made sure that, or also received a social license to operate, which they were able to then go on and go forward with. Sometimes credibility is not always about certainty. Sometimes credibility comes about because of the honesty and the approach that a company will take, and really kind of being in the right moment at the right time in front of the right people, and being very open with the plans, aspirations, but also the unknowns with which one is trying to go through. So I'm Jamie Strauss. I'm the founder and CEO of Digbee. And it's my pleasure today to get into the second part of this 4-part webinar series, focusing today on building credibility. And for those who don't know Digbee, we very much have a vision of transforming the mining industry. And I've been in this industry for 30 or 40 years. I understand that accessing capital is difficult. I understand that the challenges with which junior mining companies have to access capital really have been holding this industry back. And I think it's important to understand that actually the data suggests very clearly that credibility is such an important part of this matrix. We've lost credibility in the mining industry from top to bottom, but there are great ways with which to build it and for companies like yours to effectively win, because the ocean out there within this industry is littered with problems. But therefore, it's easy to rise to the top if we can go and do a few things. In reality, mining companies struggle to attract investment because they can't credibly prove that they're managing risk and acting responsibly. So Digbee, just for those who don't know it, provides independent mining-specific sustainability assessments that builds trust with stakeholders so that they can reduce risk, unlock capital, and enhance their reputation within the mining industry overall. So the mining industry really, I believe, is in a credibility crisis at the moment. I mean, we've seen the mining sector come from over 10% of the global indexes to less than 2.5%, effectively an irrelevant sector, which many pass over and don't need to effectively have exposure to it. Commodity prices have been rising, but sector valuations continue to suffer. Investors perceive mining as a high risk and a relatively low responsibility industry, I think incorrectly. If the sector doesn't stand up and control its own narrative, then others, such as NGOs and media, will continue to do so and will continue to unfairly and inaccurately paint this sector. So what do investors really want today? Well, let's start from the position of the stats. 83% of all projects go over time and over budget when they go through development. And they go over budget by over 40% on average. Now, that's a pretty poor advertisement for investment into the industry. So how do we effectively reverse that? First of all, if we can provide clear, proactive risk mitigation to effectively improve the narrative, but also to actually lower operational and reputational risk, then we're way ahead of the curve. Companies generally have been ill prepared when they go into Equator and IFC principles when they come to development finance. Not only does that delay things, but it also puts them at a disadvantage in terms of value. Alignment between sustainability goals and management decisions is absolutely critical so that we've got a culture internally that can effectively lead this company to deliver a project on time and on budget. I believe, after talking with many investors of all different areas of the spectrum, that they're looking for proactive risk mitigation, not reactive. That there's internal alignment between board management and the operations, where there's credible and strategic communication. It's no longer good enough just having an intent to be sustainable, responsible, whatever word you want to use. It must now be backed by proof rather than just by marketing. So, as I said earlier, I recognize the challenges which are out there for, particularly for the junior mining sector. This is to some extent new. We didn't see any value in outlining a lot of this before. And I think also it's a pretty unique challenge. Virtually all companies have scarce resources, there's no revenue, and there's a high level of uncertainty that we're battling against. But sustainability is an element of valuation that is increasingly valued as a differentiator between those companies that are embracing it, lowering risk, and communicating more effectively, and those that are not. It's no longer sufficient just to say that we've got good technicals, geology, engineering, or whatever. We've got to have a strategy and a plan with a bigger, broader risk strategy that is communicated effectively so that we can attract serious capital. And this is why I believe that juniors can and should differentiate themselves through the lens of credibility and not just focus on either their resource size or a grade, etc. Now, how do we effectively go through this in practice? Credibility begins with early stage risk mapping, not just in terms of the technicals, but all of the different areas from the moment we get an economic deposit, all of the different areas so that we can effectively get through into production and we are ahead of the curve of all of these different things. It's foresight, not firefighting. Alignment with the board and management builds confidence all the way through the organization. It demonstrates to investors that they're organized and coherent. How do we then build upon this is through independent verification. The sector at the moment is short on credibility. So independent verification can not only lead and guide a company and a management team in order to de-risk further, but it also demonstrates the ability for that company to demonstrate its confidence in its future and its roadmap. It also overcomes another stigma, which is greenwashing. As of the fallout of ESG over the last few years, regulators have very much been on top of the greenwashing, and a lot of companies have just pulled back completely, not putting out any information, being scared of legal challenge. This is not the best way to communicate and transparently build confidence and trust with different stakeholders. So if we can effectively address what the regulators need through an independent assessment and have confidence in that disclosure, then we can not only address confidence with investors, but also with regulators and communities and others. Social license to operate is driven by that stakeholder engagement. It needs to be real, ongoing, and rooted in shared value. By doing that, again, we can espouse strong confidence, stronger engagement, and a social license to operate that we can build on and be proud upon. What I like about social license to operate in the modern world is that it's becoming an increasingly valued commodity within the mining industry. Investors who can see and be shown and can be demonstrated the impact that that is having, rather than just a single slide to say we believe in something, is really beginning to influence investors as to how they're going to deploy capital. So I just want to touch on a business case that we've experienced ourselves, where a development stage company came and signed up to the Digbee process and went through and had an assessment. Following that assessment and the feedback that they were given on all of this, they had a clear roadmap of going forward. It aligned their board and identifying core risks which they could prioritize, and then a roadmap ultimately, obviously, to de-risk and go forward. What was interesting is they were able to actually bring forward a future assessment ahead of some M&A due diligence, so that they could then demonstrate that trajectory. And as part of this, the company now stands out as being part of a lower risk cohort, which I believe is going to lead to improved valuations and a lower cost of capital. Why? Simply because we've built trust and confidence with our different stakeholders and investors. They're able to be better prepared to go into due diligence and go through with that quicker. And they ultimately can communicate a credible and robust strategy to ensure that this project gets into production on time, on budget, and responsibly. So I don't think there can really be any doubt for the business case for credibility these days. It affects every company in every industry, private or public. There's a direct link in terms of valuations between those companies that are deemed and seen to be perceived as credible and those that are not. A credible company in the mining industry has many advantages. It can access permitting quicker. I mean, it was only recently that the US and also Norway and other countries have highlighted that critical mineral projects that can be deemed to be responsible will get fast-track permitting. But as I say, all of this will ultimately lead to reversing the years of decline and underinvestment in this industry, which has resulted in valuations falling to 3-4 times cash flow for the majors, and how everything else is then valued off the back of that. I think Marcelo Kim of Paulson very recently just highlighted something about Agnico Eagle when he was asked after the company had just become the most valued gold company. And I put this quote up here simply because the comfort with which they are found is through the confidence in the management capability of that company, which has therefore led to attractive and competitive capital, which has resulted in higher valuations. So how can we have 3 practical steps just to get a company off the ground and going forward with this? It's not rocket science. So first of all, understand the full matrix of risks that are going to affect this company going forward as it goes through development and ultimately into production. What is it that binds the company together in order to become a responsible operator once it's in production? First of all, map and fully understand those risks and those topics as early as possible. Put in place de-risking strategies before problems emerge, which then cost time and money later down the line. Use independent verification as the second point in order to raise that level of credibility with your different stakeholders, and to show that the market that you're serious as to what you're doing, but also to give guidance as to what your roadmap is looking like. And then ultimately communicate this in a clear, consistent story that aligns with investor priorities, mitigating risk and being able to demonstrate a clear roadmap and going further than just what you say in terms of action. So as the last thing in terms of just summarizing all of this, credibility isn't a luxury. It's very much a prerequisite for fundraising and being a winner against your peers in terms of accessing new pools of capital. The critical mineral industry, along with the gold price, is pulling in new investors. How are we going to align with them is absolutely the first point of call in our questions. The second thing is it improves resilience within the business model, so that you end up having lower number and frequency of issues, and that will ultimately result in under-promise and over-deliver of the strategy. Now, next week, we're going to talk about embedding responsibility into strategy. And I really want to bring a lot of this down into how can we relate this to individual roles within a company, whether it's the head of sustainability, having a strong framework to work around and moving this from a solely permitting and compliance purpose to a real value add de-risking capability with which the CEO, the COO, and other executives can reward and benefit from. How can the CFO become better prepared? How can the board of directors ultimately offset their reputational risk, but also to prioritize risks as a project and a company goes forward? And clearly the CEO who's communicating this, wanting to be a leader and to be able to differentiate their company relative to the others. So I'm really pleased to have been able to share a lot of this with you today. Let's open this up to questions, and thanks so much indeed for joining.
Hi, good evening from the UK time zone, and good day to others further west. I hope you enjoyed that, and I've got some great numbers which I pulled out, which are kind of really in the webinar for next week. But I just want to touch on this before I come to a couple of questions. Did you know that $250 billion was raised last year for digital infrastructure and energy transition in the private market? The reason I say this is that both of those subsectors, or both of those sectors within the infrastructure spend, are absolutely dependent on the mining industry. And do you know what the amount of money raised for the mining industry was against those two? Dial in next week and I'm going to tell you, because the information that came to me when I saw this simply blew me apart. And the opportunity that that provides for the mining industry is second to none for those companies that can align with those investors. Now, we've got a few questions, and so thanks for that. I'm just going to touch on a couple I can see here. How can junior mining companies with limited resources demonstrate responsibility credibly without it becoming a costly distraction from advancing the project? Well, first of all, I'd say is that the costly distraction is, I think, often weighted when the value add relative to that costly distraction can be so significant. And if you look at the argument of 83% of companies going through development not ultimately having to dilute their investors substantially, what the cost of that is against having the almost double whammy, as we call it in the UK, of having not blowing up the customer base, but also creating a premium valuation, far outweighs an independent assessment with clear observations to identify areas of risk which we can mitigate quite quickly, and to some extent either for a small cost or perhaps none at all. So I think having that roadmap for any junior mining company going through the early stages of development and all the way through into production really is an easy way to be able to not just address that question, but actually be able to create the value and avoid the risks, which are the statistics say are only almost certain to come. Second question is, in practical terms, what does the management team do differently to build trust with investors beyond publishing sustainability reports or adding ESG slides to presentations? Well, I wrote an article, you can go onto our content site last November, about sustainability reports. I really question the value add of sustainability reports as they're written today, not to the extent that whether or not they are valuable or have the potential to be valuable. I'm completely supportive of that. But if we don't ask who are they designed for, who are they targeting, what is their purpose, and what is the value add, then I question, or I suppose the statistics of people reading these documents really kind of answer the questions. They're not really addressing the question. So in practical terms, what does a management team do differently is it gets on board, it embraces sustainability by, first of all, mapping out the risks through an independent assessment, and then going through that process to identify those risks with which they can mitigate, or at least to put strategies in place over time to again lower that risk. Just touching on ESG slides, look, every company has a "we are responsible" slide in the deck, and it's usually got a nice green tinge to it. Frankly, they're a waste of time and a waste of the ink. What we really want to try and do is to look into the eyes of the fund manager, either on the Zoom call or across the table, and give them in the first 2 or 3 minutes the ability to think in their head, yes, I can invest in this company if I like the asset. Because frankly, I think we're missing the point on communication. We know that the greatest area of risk is the area from the moment of development all the way through to production. That's when the capital structure gets blown up. That's what they're scared of. That's what they want to have the confidence on, that this management team is aware of that, can address that. So work out what those ESG slides or sustainability slides are, be bold with them, give real data, and put them up front and early in the presentation so that you can gain that level of confidence and credibility really early on. I think it will also save time on lots of questions later on down the line as well. One has just come up saying, is there objective data that confirms that companies with strong ESG achievements can access lower capital cost? Lower cost of capital, or is it a binary and certain that large institutions simply will not meet with companies with unconfirmed ESG achievements? Well, first of all, I'm going to be frank and open here. Look, I think, first of all, we've got to recognize the total spectrum of investors. And there are largely high net worth individuals which have come from previous cycles who, frankly, won't really care too much. There are younger, new investors, individuals who've grown up with sustainability as a core part of their beliefs. I think they are beginning to infiltrate into institutions and have significant impact. And I don't think the mining industry has fully recognized that. And I think that's an important element. I think it goes back to the 1% of the equity markets. It's clearly ridiculous. I mean, it's almost nonsensical that this fundamental industry should be so lowly relevant to all of the other industries. And when you tie in the cash, the valuations and the cash flow yields and everything, that almost kind of underlines that. So how do we reverse the consideration of younger people in institutions to think that the sector can be responsible and therefore can be rewarded with investment rather than just being ignored? To answer the question directly, though, is there objective data? I think there is objective data, but not necessarily from where you think it's most likely. So if you're talking to an off-taker, they have to make sure that their supply chain is deemed to be responsible. So the capital coming from an off-taker requires sustainability to be part of that. And if you're not, you're either not going to be given preferred status, or which therefore means you effectively take a discount, or you don't get the investment at all. So to me, there are angles within the investment framework which are beginning to integrate this and therefore lower the cost of capital. And that lower cost of capital I just mentioned is if you become a preferred supplier to a OEM or whoever it happens to be, that will typically be a 10-year contract rather than a 1-year contract. Is that a lower cost of capital? Yes, because you've got the security and the long-term nature of that. And I think institutions, depending on where they are, clearly Europe leading relative to other parts of the world, but institutions, depending on where they are within the matrix of investment, are increasingly requiring sustainability be at the front of the conversation. Private equity already requires that. If you don't have that, you're going to find a long-winded, boring, slow approach to going through Equator Principles or IFC process. So get ahead of that. I think there was one other one. You mentioned the need for companies to communicate risk mitigation more clearly. In your view, what's the single most overlooked risk that mining companies fail to address in their narratives? Well, I'm going to be a bit facetious here and say, well, if you're not embracing sustainability, that is your single biggest overlooked risk. Think of it. Do you want to have the risk of being part of the 86%, or do you want to be part of the 17%, which is premiums? And I think that's the biggest differentiator. If I'm being less facetious and I kind of talk about the actual specific overlooked risk, I think it is to some extent dependent on where you are in the world and what you're looking for. Clearly, if you are not up to speed on where you are with tailings, then that is a fundamental problem which will delay things. I think governance is often overlooked, and I think that is arguably the single biggest overlooked risks, simply because it is the glue that puts in the environmental and the social side together. But then you pull me onto the social side, and if you haven't started engagement with local communities early enough in a transparent way, then frankly, you've got to be looking down in some parts of the world as to whether or not you're ever going to get this project off the ground. The good news is that geologists tend to be on the ground early and do have good social relationship capability, and therefore I think things do generally get off to a good start. But that is really important, and that needs to be built on, and we need to listen more to the communities so that we can effectively communicate and be transparent back to them to get their support on site. So yeah, this is a bit of a question that could go on and on. But I think hopefully, if there are no more questions, I think I've covered all the questions. So on that basis, I'm gonna sign off by saying, do look out for the invitations for next week. That data I picked up this week is one new question. That question. What about royalty companies and project financiers? Are they increasingly demanding evidence-based ESG ratings? But I'm on the board of a royalty company, and the answer is most definitely yes. And you can get real advantage here. If you're better prepared, what are they looking for? They want that royalty to go into production sooner rather than later if it's a development royalty. Therefore, those companies that can present those credentials clearly upfront and easier, most definitely will have an advantage. And you may even be able to so there's definitely an advantage on that. So just coming back to next week, I've got those great statistics that I've got. I'm looking forward to that. Do look out for the invitations. I'm really enjoying this, and hopefully you are as well. And have a great week between now and then. Bye-bye.